Hello, it's Matt Linklater here, and I want to share with you a life insurance comparison I did for one of my clients here recently. So here's the life insurance analysis, and here are the two things I really want you to think about when you're thinking about your cash value life insurance out there. Is number one, am I paying the least amount for the death benefit? So what is my premium and what's the death benefit? And can I lower that premium to get the same death benefit? Number two is, because life insurance is, for protection and that death benefit, but it also comes with some living benefits. So there's some cash value and projected income or projected withdrawals in the future off of your life insurance. So the second thing you need to ask is, can I accelerate the growth of that cash value within my life insurance contract, and how do I do that? So I don't want to get too far ahead of myself. I'll explain to you the analysis I did as I go, but I just want to recap and share with you, why am I talking about this? Everything we do is about the family office. Is how do we provide you with the complete analysis of all your finances in one place so we can accelerate your wealth. And so when we put the family office together in the triangle of wealth, where we have a tax attorney, a CPA, and financial advisor always analyzing your situation, we can help you come up with the best solutions for your business and for your family. So we work in four main quadrants, if you will. We go cash flow is king, where we do accounting and tax preparation services. We also do advanced tax planning, where we outsource to tax attorneys. Maybe a different type of structure or another structure is right for your assets. The other thing we do is the bottom left there is financial advisory. Can we help you decrease your costs and protect your portfolio? And then number four there is insurance. How do we maximize your insurance? And that's really what we're talking about today, is doing that insurance analysis, insurance review. So a gentleman came to me, he's a 53-year-old healthy gentleman, and he had a whole life contract. His death benefit on that contract was $2.3 million. His premium was $54,000, and his policy value, his cash value in there, was $490,000. So I said, okay, what is the income projected on this? So at age 60, it projected over $60,000 in income. Age 65, $98,000, and age 70 was $152,000. And so I said, well, okay, let me go out there and let me take a look. So one of the things we look at is Index Universal Life. We like Index Universal Life because you can keep up with inflation. Your cash value does not go down with the market, if you will. Provide some tax-deferred growth and possible some tax-free income if you structure it properly. So here we said, okay, in this Index Universal Life, we're going to get you the same death benefit, we're going to get you the same premium, and we're going to transfer over that policy value. And a transfer in IRS terms is a 1035 exchange. And ultimately what that means is that you are transferring from one life insurance policy to another life insurance policy and not incurring any tax liability. It's called a 1035 exchange. So then on the Index Universal Life, I said, okay, well, what are some income projections on the Index Universal Life? So you can see at 60, we went from 60,000 over 90,000. At 95, we went from 98,000 to over 154,000. And at age 70, went from 152,000 to 245,000. So you can see those increases are over 150% increases. Now, what's the difference? The big difference is this. Whole life is really tied to the interest rate market and the dividends of the life insurance company, which those dividends and are also tied typically to the interest rate market. And you know that we've been in a very low interest rate market at least over the last 10, 20 years, at least since 1999. So now, when you look at Index Universal Life, how is their rate of return calculated? Well, in the strategy I'm going to share with you, it mirrors the S&P 500. And so if the S&P 500 goes up 10, you're going to get 8.5%. So you get 85% of what the S&P 500 does. So if the S&P 500 goes up 20, you are going to get 17%. So again, 85% of what the S&P 500 does. And so when you look at the S&P 500, it's the 500 largest companies in America. It represents over 80% of our economy are those companies in the S&P 500. So you're getting S&P 500 like returns, but you're going to say, Matt, what's the catch? So I get 85% of the upside. Well, if the S&P 500 drops 20%, you stay even. You do not lose. And I'll explain this a little bit further here in a moment. But essentially, you get 85% of the upside of the S&P 500 without any of the downside. So take a little further. Here's the illustration for the gentleman. He was 53 years old. If he pays that $54,000 all the way to 64, he's going to have $1.1 million. He's going to have invested $1.1 million or paid $1.1 million in premiums. He projects to have just under $1.7 million in cash value. And his legacy, you can see there, his death benefit grows from $2.8 million down to $3.9 million. Now, here's the thing. At age 65, he doesn't need that death benefit anymore. So we're able to take that death benefit down from 3.5 down to 1.9 million on the top right-hand side there. His tax-free income in green there at 65 is $154,000. So this projects $154,000 in tax-free income from 65 to 95. So he put in 1.1 million, if you remember from the previous slide, and it projects from 65 to 95 to pay out $4.7 million in tax-free income. Now, on the right-hand side there, you can see on his 7% illustrated rate of return, his cash value is going down because he's taking those withdrawals. He's still earning possible 7% on average, but because of those large withdrawals, his cash value is going down. And then on his right-hand side, you can see his legacy is declining as well with those cash values. So again, he used it for great death benefit protection while he's working. When he goes to retire, he can shift over and possibly use it for a supplemental retirement income. So where are we getting these types of returns? And so like I said, this is based on the S&P 500. And to be more specific, what it is, a low volatility index. So what they do is choose the least volatile 100 S&P 500 stocks. So they take 100 out of the 500 that are the least volatile. So instead of trying to hit home runs with the S&P 500, they're saying, well, how do we manage the risk and get you a bunch of singles and doubles? So try to get you as many upside years with a return as possible with those least volatile 100 companies. And you're getting 85 participation rate. So as I said in the earlier example, if you go up 10%, you're going to get 8.5. If you go up 20%, you're going to get 17. But if the market goes below zero, you're not going to lose. So just let's take a couple here. Let's look at 1991. 9.57% rate of return in the S&P 500. You received 8.13. 1994, down 6.14%. You didn't lose. 95, big rebound, 33% in the market, but you captured 28% in the market. You go out to 99, these 100 stocks were down 11.5. You did not lose. The big thing people really look at is how about 2008, down 25%, and you didn't lose in this portfolio. So the big thing is the compound average over time in the S&P 500 or these 100 stocks of the S&P 500 was 7.34%. Now, when you erase the down years and only get 85% of the upside, you go from 7.34% to 8.32% on your compounded rate of return. Now, I'm not saying this is the right strategy for everybody. This is just an illustrative example of how we help our clients to make decisions. Now, we want to look at your overall situation. What are you trying to do? Your overall net worth. There's a lot of different things that we got to make sure with your risk tolerance and things of that nature. But I wanted to share with you there are some strategies out there that can help you get the death benefit protection that you want, and then also maybe accelerate some of your cash value. So the two things to really think about when you're looking at life insurance, your life insurance policy is, when I look at my death benefit, could I lower my premium or pay a lesser premium for the same death benefit? Or for the premium I'm paying into life insurance, how can I preserve that same death benefit but accelerate the growth so I have possible cash value that I can tap into the future for things like kids' college education, kids getting married, if I want a business expansion, or lastly, obviously, if I want to supplement my retirement income. Again, the strategy is not right for everybody. Just wanted to share with you a comparison to share with you how our family office strategy can help you maximize the dollars and the cash flow that you're utilizing each and every year. And so really ultimately is, how do we maximize your cash value, and how do we help you build wealth in the best way possible for you, your business, and your family. So if we can help you out and you want an analysis, please just give us a call. Our phone number is on our website. You can register right next to this video on our website and schedule a time to meet with us. and just let us know how we can help you out in maximizing your wealth for you, your business, and your family.